To provide a holistic picture of the London Credit Fund, we need to list the associated main risks and the ways these are managed and mitigated. Since the assets securing the loans are UK properties, the fund is exposed to property market risk. This is managed by having a protective buffer of at least 25%, since the maximum loan-to-value is 75%. It is noted that the largest ever year-to-year price decline in the London residential markets since 2009 has been 22%. Now, in relation to property valuation risk, the London property market is one of the most liquid and mature property markets in the world, meaning that it is relatively easy to estimate a property sale value. All security properties are valued by independent RICS registered valuers that have a professional indemnity of up to £10 million. Credit risk is the possibility of loss resulting from a borrower's failure to repay. As mentioned above, all individual loans have a minimum protective buffer of 25% per loan, subject to a maximum loan-to-value of 75%. Additionally, UK legislation ensures swift security enforcement when and if deemed necessary. Usually, enforcements take on average 3 to 6 months to be finalized. In relation to fraud and legal risk, fraud checks, covering among others KYC and identity checks, are performed by London Credit Limited, a Consulco group company and the loan originator. Additionally, experienced external UK licensed solicitors are engaged to carry the due diligence on both the borrower and the security property to ensure no irregularities. London Credit Limited has fraud insurance of up to £5 million. In cases where the initial currency of the investment is the euro or the US dollar, the investment might be impacted by exchange rate fluctuations between the sterling pound and the initial currency. We mitigate the risk by hedging the currency risk and entering into currency forward contracts. Relating to liquidity risk, the underlying product in which the fund invests in is liquid by nature. Bridging loans are short-term with an average duration of 9 months. Also, the fund may maintain at any point in time up to 10% of its assets under management in cash. Concentration risk is managed by incorporating some concentration risk restrictions in the operation of the fund. For example, exposure to a specific loan cannot exceed 20% of the fund's portfolio size, or participation in bridging loans having second instead of first charge security over the property cannot exceed 15% of the fund's portfolio size. The product risks are identified and managed in a way where the investment risk is a measurable parameter. In a world where low and negative yields is the norm across fixed income markets, the London Credit Fund provides an attractive combination of fixed income returns and prime asset type security.